Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
In today's episode, you'll learn about first heading into today's open. A political firestorm rocks the Fed, sending gold skyrocketing to record highs overnight. With stock futures plunging, will the opening bell trigger a full-blown crisis or a surprising reversal? Second, Fed chair versus the White House. Powell's bombshell accusation triggers market chaos. Gold surges to historic high. The Fed's independence is under siege, sending shockwaves through global markets. Is this the end of the dollar's dominance, or just the beginning of a constitutional crisis priced into every asset? Finally, AI King's record profit masks hidden danger. TSMC's guidance is now make or break for the entire tech sector. The chip giant's stunning 59.5% margins are fueling the AI boom, but its massive spending spree risks a historic bust. Will their forecast ignite a new rally at the open, or will whispers of margin pressure trigger a tech bloodbath? Red alert. The institutional foundation of the US market is shaking. We are witnessing a historic collision between the Department of Justice and the Federal Reserve, and the safety valves in the asset markets are already blowing off. While the S&P 500 inches toward the psychological 7,000 level, do not let the calm surface of the equity market fool you. The real action isn't in stocks right now. It is in the violent repricing of hard assets. Gold has shattered records, screaming a warning that the broad equity market has yet to fully acknowledge. The critical story dominating global capital flows is the Department of Justice opening a criminal investigation into Federal Reserve Chair Jerome Powell regarding statements made to Congress. This is the most significant challenge to central bank independence since the 1950s. The market's reaction is bifurcated and telling. Smart money has already moved. Gold surged to an all-time high of $4,568.36 per ounce yesterday, entering what technical analysts call a price discovery phase. A technical breakout into uncharted territory that often targets psychological levels like $5,000. Silver outperformed even more dramatically, jumping over 4.5%. Why is this specific investigation driving such extreme price action? Because it introduces tail risk, a low probability, high impact event that models rarely account for. This is not a standard inflation hedge. This is an institutional hedge against a compromised Federal Reserve. The market fears two scenarios: either a politicized Fed that cuts rates prematurely, leading to stagflation, or a Fed that loses credibility, triggering a credit market disruption. Yet, we see a dangerous divergence. While precious metals are pricing in a crisis, the VIX, the volatility index tracking equity fear, remains subdued at 15.38. The equity market is effectively ignoring the risk that the bond and commodities markets are screaming about. This gap between the panic in gold and the complacency in stocks is the single most critical indicator to watch right now. Adding fuel to this fire, tomorrow morning brings the December Consumer Price Index release. Consensus expects a headline increase of 0.3%. However, the risk here is asymmetric. This is the first report expected to show the pass-through costs of the administration's new tariff regime on goods like apparel and vehicles. If headline inflation surprises to the upside, hitting 0.4% or higher, the entire narrative of rate cuts for 2026 could collapse. Simultaneously, we are awaiting a Supreme Court ruling on the legality of the administration's reciprocal tariffs. This is a binary event. Moody's Analytics has stated that a ruling against the tariffs would be the fastest way to boost the labour market. If the court strikes these tariffs down, we could see a massive, violent rotation out of mega cap technology and into the Russell 2000 and industrial sectors, which have been suppressed by trade war fears. Speaking of technology, the concentration risk in the Nasdaq has reached levels that demand attention. The top 5 technology stocks now account for over 53% of the S&P 500's total return. This is a crowded trade. We are seeing clear winners and losers based on tangible AI revenue. Micron Technology has delivered returns exceeding 230% over the last year, driven by insatiable demand for high bandwidth memory in AI data centers. Palantir is up over 140% as it proves it can monetize AI software for enterprise clients. However, beneath the surface, market breadth is deteriorating. Capital is beginning to rotate into the Dow Jones Industrial Average, specifically favoring financials and industrials. Investors are bidding up large cap banks, betting that a higher for longer rate environment will pad net interest margins, while simultaneously hedging against the Fed crisis with gold. This is a sophisticated defensive posture masked by near record index highs. The next 48 hours will define the trajectory for the first quarter. We have the CPI data tomorrow morning, TSMC earnings later in the week to validate AI capital spending, and the looming Supreme Court decision. The disconnect between gold prices and equity volatility cannot last. One of them is wrong. Watch the 4,200 level on gold and the market's response to tomorrow's inflation print. The easy momentum trades of 2025 are over. This is now a market of headline risk and rapid sector rotation. The story begins with a decision that caught everyone by surprise. The independence of the world's most powerful central bank is on the line. Federal Reserve Chair Jerome Powell has made an explosive and unprecedented accusation, stating that a US Justice Department investigation targeting him is a pretext for political influence. The goal, according to Powell, to pressure the Fed into cutting interest rates faster. We've been flagging the mounting political pressure around the Fed for a while now, everything from threats to fire Powell to the Supreme Court case on whether a president can remove a sitting Fed governor. Today's DOJ probe is a clear escalation of that same risk. This bombshell statement has sent shockwaves through global markets overnight. Ahead of the bell, the reaction is clear and sharp. US stock futures have dropped. The US dollar dipped against every single major currency during the Asia session. And in a classic flight to safety, the price of gold shot to a record high. We previously noted the dollar's nearly 9.5% slide last year. The latest leg lower looks less about data and more about governance risk. Interestingly enough, this isn't just a typical flight to safety. The rally in gold is increasingly seen as a barometer for de-dollarization. This means global central banks, including the People's Bank of China, are diversifying their reserves away from the US dollar due to exactly this kind of institutional uncertainty. We've been tracking this for a while. Central banks have been buying gold at a historic pace for 3 straight years, and the World Gold Council's recent survey showed that an overwhelming 95% of central banks expect to increase their gold reserves. That backdrop also echoes what we highlighted earlier on the physical side, buyers in China and India willing to pay steep premiums for silver, pointing to a growing divergence between paper prices and real-world demand. This signals a potential structural shift in global capital, and it's a trend we'll be watching closely. This isn't just a political spat, it's a direct challenge to a bedrock principle of the US economy. For decades, investors have relied on the Fed to make decisions free from political interference. Now, that trust is being openly tested. We previously analysed how this kind of pressure creates a credibility gap for the Fed, and today's development brings that risk into sharper focus. Now, get this. The entire situation hinges on credibility. If the public and investors start to believe the Fed can be politically influenced, it risks unanchoring long-term inflation expectations from the 2% target. The latest data from the University of Michigan survey shows these expectations are still stable for now, but any change would be a major red flag. If expectations become unanchored, a future Fed would face a terrible choice. Either induce a recession to regain credibility or accept permanently higher inflation, a painful echo of the policy mistakes of the 1970s. As we've discussed before, that's also when Fed communication tools think the dot plot lose reliability because markets question whether the guidance is driven by politics rather than data. One chief market strategist captured the anxiety perfectly, warning that using aggressive legal threats against Fed officials is like pouring gasoline everywhere and then playing with matches. He added that it could erode the dollar's safe haven role and trigger a sharp rise in borrowing costs across the entire American economy. So the thing is, when investors perceive this kind of political risk, they demand extra compensation. This is what economists call a political risk premium. Heading into the open, watch the yield on the 10-year Treasury note, which is a benchmark for borrowing costs across the economy. If this yield starts to climb, it's a sign that markets are pricing in this new risk, which would make everything from mortgages to corporate loans more expensive for everyone. This could structurally increase the US government's borrowing costs and directly challenge the dollar's privileged status as the world's main reserve currency. That ties back to the longer running pattern we've been following, global investors favouring hard assets over fiat as Fed credibility is questioned. The conflict pits President Donald Trump, who has repeatedly attacked the Fed for not cutting rates faster, against the institution designed to safeguard the nation's financial stability. While the president has denied knowledge of the Justice Department's actions, the battle lines are drawn. And it's worth remembering Powell's term as chair ends in May, so the political stakes around the Fed's leadership and independence are only getting higher. As trading begins, the core question is how investors will price this new profound risk. The market moves overnight show deep concern, so at the open, keep your eyes on a few key indicators. First, as we just discussed, the 10-year Treasury yield will be a crucial gauge of fear. Second, watch the US dollar index, often referred to by its ticker DXY, to see if the overnight weakness continues. And third, keep an eye on gold prices. They are no longer just an inflation hedge, but a real-time indicator of global confidence, or lack thereof, in US institutions. For confirmation of the broader hard asset bid we've been tracking, a quick glance at silver futures alongside gold can help. The open will reveal just how much this fight over the Fed's soul will cost. We were just talking about a major institutional risk shaking the markets. Now, let's shift our focus to one of the biggest drivers of market growth. The undisputed king of AI chips, Taiwan Semiconductor Manufacturing Company, or TSMC, following its earnings report overnight. A while back, we flagged how choke points in AI hardware could swing entire markets. Today's print puts that thesis to the test. Here's where it gets interesting. Believe it or not, TSMC has become a single point of failure for the entire global AI supply chain. Research shows TSMC now controls a staggering 72% of the market for the most advanced chips. This means any issue at this one company could trigger a global tech downturn, making its health a critical financial indicator for everyone. We previously analysed this choke point dynamic across the stack. Today's focus is the foundry at the centre of it. Analysts were projecting a record-shattering $15 billion profit for a single quarter, a stunning 27% jump driven by insatiable demand for artificial intelligence. That insatiable demand is giving TSMC immense pricing power, with its latest gross margins hitting a stunning 59.5%. This is wild because while we're seeing inflation cool down for many goods, TSMC's dominance could signal a new wave of tech-specific inflation. This could complicate the Federal Reserve's last-mile fight against inflation, as the rising cost of these essential chips could eventually mean high prices for the phones and computers we all use. Remember when we noted the Semiconductor Producer Price Index had turned up and the era of ever-cheaper computing might be ending? This is that story, concentrated in one company's margins, and it's why some strategists at Morgan Stanley have warned inflation could stay above target longer than markets expect. As the key supplier to tech giants like Nvidia and Apple, TSMC's market value has swelled to $1.38 trillion, more than double its rival Samsung. This widening lead is precisely what solidifies TSMC's role as a critical choke point in the US-China tech rivalry. The company's technology roadmap is now seen as a direct barometer for the West's technological lead. The impact of this is already visible. As US export controls have tightened, TSMC's revenue from China has actually fallen to just 8% of its total, down from a pre-trade war norm of around 11%. This shows just how central the company is to these geopolitical currents. Continuing our last discussion of policy-driven splits in the tech supply chain, this is the demand-side manifestation orders reshuffling as controls tighten. One analyst highlights the core conflict, noting that while TSMC gains share at the cutting edge, its competitors are, quote, struggling to keep pace. The engine behind this dominance is what one research manager calls the explosive growth of the AI server market, a sector projected to grow an astonishing 78%. This has fueled such intense demand that the company's most advanced 3nm chip factories are reportedly at full utilization. A few days ago, we also highlighted the other side of that build-out. Data centers' electricity demand is surging, a parallel bottleneck that can shape the cadence of chip orders. But that's not the whole picture. The real turning point could be the guidance. The company is pouring a massive $165 billion into new factories, including major facilities in the United States. We previously called this the investment tsunami CapEx that's been powering growth, but also adding to pocket inflation. For today, note that analysts are penciling in roughly 25 to 30% revenue growth in 2026, tied to AI accelerators, suggesting end demand may be keeping pace with spend for now. The key here is understanding the historical risk of this kind of spending. The semiconductor industry has always been famously boom bust. In the past, huge waves of investment like this often led to an oversupply of chips, causing prices and profits to crash. So, this massive capital expenditure is a huge test. Is the AI revolution a permanent shift that can absorb this new capacity, or are we risking a future supply glut? As we've warned before, that's where bubble risk creeps in if profitability fails to keep up. Following its earnings call, the crucial data point for traders this morning will be its forecast for the coming year. That forecast will signal whether this incredible momentum can continue or if the massive spending will begin to weigh on margins. And if the inflation angle shows up in the language, keep an eye on longer dated yields alongside the semis. However, if you zoom out, you'll see another layer of strategy at play. Building factories overseas is more expensive. Research based on the company's own statements suggests that these new fabs in the US and Japan are expected to dilute or reduce gross margins by 2 to 3% annually. This is the economic cost of so-called reshoring for geopolitical security. So heading into the open, watch for any confirmation or adjustment to this 2 to 3% figure in their official guidance. It will be a major signal about the long-term profitability of this global expansion. As we've discussed before, reshoring isn't free, but it does spread risk away from a single geography. Watch shares of TSMC and the entire VanEck Semiconductor ETF, which is the SMH, right at the bell. The SMH, by the way, holds a basket of major semiconductor stocks, so it's a great way to gauge the health of the entire chip sector. As we said a while back, also keep an eye on AMD and NVIDIA for a clean read-through on accelerated demand and how investors are pricing the AI build-out. The company's forward-looking statements will be a major test for the AI narrative that has powered this market and could set the tone for the entire tech trade heading into today's session. We previously framed this as a split screen between tech leadership betting big on AI and policymakers worried about inflation. Today's guide is the latest verdict.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.